Well, hey everyone. This is Warren Howe. Hope you're having a great day as always. Now, we're live on Facebook, so let me just share my screen. Today is a well, it has been exciting when the results came out, but not so exciting when the stock price reflects it, right? So today we're going to talk about SoFi and the Q4 full year results. What is the game plan? What is the outlook? What do we expect from this company? In revolt when it comes to this year or next year, what is to be expected? So stay tuned. If you're watching this live right now, show brother some love. Yep, you know the drill. Drop that smash that like button, smash that heart button, and type the hashtag live if you're watching this live. You know the drill. Or even say anything that if you are invested in SoFi, let me know in the comments. Let me know in the chats. If you are not, because I know that this group, you guys are, invested in SoFi. You guys actually, you want to know the game plan. Yeah, so let me know, guys. So let's get to it now. And by the way, if you're watching this on replay, click hashtag replay so that I know you're here. The purpose of this live is that we can interact with each other. If you got any questions, I'll, be more than happy to answer them for you. All we need is interaction. So the flow of this, live is that we will go through the investor presentation. We'll go through the transcript and we'll go through the 10K, right? Hopefully we have time to do all that. So here I would say the good news. Well, I wouldn't really say good news. I would say we want to determine the plan, right? So the good, the bad, the plan, what's the outlook, especially considering the macro, events happening right now. So this is it. Record growth in new members. Now, for those of you that have been following up, their performance is insane. Yep. For a company that is lower down in the S curve, which is, SoFi, they're new, for their progress, for what they have done, it's actually really, really powerful. Yep, it's really powerful in terms of testament on what their management is doing, their marketing strategy, all this good stuff, right? So that's what I'm trying to say. I mean, their record growth in new members, right? And the ratio to that for their new products is actually really, really powerful because it's not, I mean, obviously the members are not as, triple digit, but I can hear the haters say, oh, it's not triple digit anymore. It's not 100%. It's 87%. It's actually declining. It's plateauing. I even see articles it's seeking alpha, which I do not agree. I mean, I think this is really good progress. You added 520. I look at the quantum amount, right? We got 523,000 members added in Q4. That is just crazy, especially when, the headwinds are actually towards us. This, in my opinion, is good. So, but what is to take note out of this is not only do we need to see member growth, we need to see product growth as well. Yep. So record growth in members, 523,000 Q over Q to 3.5, which is 87% year on year. 39% more member adds than Q3 2021. This is crazy. Okay. Now, why do I say we need products? It's because imagine you got a new member using SoFi Money, which is top of the funnel for them. Yep. SoFi credit card. Okay. Which is the easiest sort of, you entice them easier to join, right? So imagine that. And imagine them using more and more products. So let's say member number 1, you got 2 products. Member number 2, you got 4 products. Member number 3, you got 8 products used, right? So the reason why they've been adding more products is because you can actually see that overlap per member on average using more products. So more members over more products, more products over more members would mean that the CAC, the cost of acquisition, the upselling, the cross-buying works. Because the story within SoFi, as sexy as it is that they need to lower down marketing, which they have. We'll read through the transcript. not mistaken, by 12, 18%. I forgot the amount. They managed to actually reduce sales marketing per customer based on what they, their metrics. And that is seen testament by the growth of members rather than, growth of products rather than members. Okay. So that's what it means. It means that, if there's more products, simply means that more members are actually using more products per, and that's where the compounding effect takes in, because as you cross by and you got Galileo with all, 100 million accounts, you got Technisys, which they just recently acquired and succeeded into closing the acquisition. You have SoFi Lantern and SoFi at Work and all these things, right? So the story is that they are using all of their products at hand, their highlights, to be upselling and cross-buying, so that every member, there's a chance to, monetize for free. That means you don't need to convert them from product to product. It's more like it's the case of Apple, and that's what they're promoting, right? Whether or not it works to that level will need progress. Obviously, we'll need them to build. So that's what I want to say about this company. I mean, this is a company where they're low down in the S-curve. It'll take time for their things to be realized. So as investors, right, forward-thinking investors without emotion, we got to know the game plan of this company. The game plan of this company is that we are investing in a business, and whether we like it or not, it will take time for these businesses to actually take, fruition and the results to kick in. So do not be too demotivated that, the stock price actually is going down after blowout earnings, because the whole market sentiment is actually effing everything up, right? Upstart, their peer went really crazy, because it's a crazy guidance and they're already profitable. Now, SoFi is not profitable yet. That's why you see that huge hike out. So it's a matter of timing, right? So Upstart sort of went up during a sort of rebound when the news was there. But SoFi had raw earnings when things are actually getting way worse, right? So that's what I want to point out. Like, do not get demotivated by the stock price. If your portfolio management allows it, you could average down simply because their fundamentals are getting better versus when they got IPO'd, right? So this is one perspective that we can look at, okay? So we call growth in products, 906,000 quarter over quarter to 5.2 mil, which is 105% ad, 51% more product ads than Q3 2021. So that's insane. Galileo, right, which is their backbone, allowing them to be vertically integrated, allowing companies to be, to basically have fintech operations, fintech products. They have 100 million accounts, right? From I think it was like 83 clients or something like that. I forgot the amount. So lending and FS products, right? Growth in products and members. So you can see lending products actually growing slowly, but that's where the chunk of the revenue comes in. The only reason why the products are not as great is because it's already so, there's only a few. That's number one. Number two is that there's only so much that they can do in terms of lending products, right? You got personal loans, you got home loans, you got student loans, right? Which is a halt. And then, but the FS products, the FSP products, right? So they have 3.5 million members, 155% growth. You got 4 million products. That means that it's growing very nicely. We would expect, so when the products grow for FSP, we would expect to see more revenues actually taking place. And that's where the story is. I don't know if you guys remember, I did a live on SoFi. The story of them taking place would be their FS revenues get any more reflected and growing quarter over quarter, year over year, and having a bigger contribution of the total revenues. That is the story that we are expecting to see. And that's playing out, right? We got 4 million products. So FS productivity loop. Now, the thing about this is that, think about it. So this is exactly what I want to highlight in terms of growing fundamentals, but decreasing stock price, right? So we got FSPL. FSPL has reached an inflection point, which creates marketing efficiencies. We got the top of the funnel, SoFi Money, SoFi Relay, SoFi Invest having this amount of members. Ratio of financial services to lending products, total finances product. Oh no, these are products. Sorry. So financial services products actually getting lesser in terms of the ratio, but Q4 2021 the fundamentals are getting better, right? The fundamentals are getting better, and the story is playing out to having more financial services as a contribution of revenue. So now they have 1.5 million products in Invest, 1.4 in Money, Relay. The point is, it's getting more, right? The top of the funnel, easier for to loop them in, is getting more. So the likelihood of actually the likelihood of their cost CAC going lower, enticing more members to using more products, is actually getting there. And that's where they can decrease marketing over time, right? It's not like a 1 quarter thing. It's probably like a 1-2 year thing. It's probably 2 years, right? We can actually reflect in 2 years. So quarterly performance, record adjusted net revenue of 280 mil, 54% year-over-year growth. This is another crazy thing. And adjusted EBITDA of 5 mil, representing 6 consecutive quarter of positive adjusted EBITDA. Now, I do admit that this actually it was lower than my personal expectations for the quarter. I said that what is the likelihood of them, because the reason why the bulk of this is they secured personal loans, doing mortgages, right, doing house renos and whatnot, which was highlighted in the transcript. But I expected a blowout because I know student loan is not affected. I mean it won't be reflected because it was on hold. But I thought it was a blowout because the progress and the flywheel compounding effect will kick in, momentum will kick in. So I did not expect actually this to be within the mid-range of their guidance that they said. I thought that they would exceed it, but that is that. It's still an increase by 3 million nonetheless. The Ebitda was also lesser than I expected. I expected actually 15, but it's 5. It's okay. Adjusted net revenue of over 1 B and adjusted EBITDA of 30 million. So this is the final figure that I think is very important, because this will dictate and get a percentage growth CAGR over the revenues, right? So that's what we want to see. And achieving 1B, if we work out the CAGR, we would actually see their CAGR from 2018 to 2021 would be 62%. Now, when they did this presentation, they said it would be 40. I personally worked it out as like 43%. But having this 60% growth from 621 mil to 1 billion in 1 year means a lot, right? So there's a lot of good news coming from SoFi, because you can see a compounded revenue growth with the members increasing, with the products increasing, nearly triple digits. What do we expect of the revenue growth that is going to happen? Now, there's bad thing because, and this is what we share in our group, that the bad thing is that with everything that's going on, there might be another halt and extension for student loans. Ultimately, there might even be a cancellation of student loans. But the good news is that it's testament that whatever that they're doing, they're self-reliant without that anymore. They're slowly going down. So as I know, student loan refi margins are actually quite high, higher than home loan mortgages, where they have, little interest rates spanning over a period of time. But my point is, as we see, revenue growth, and this is, bear in mind, this is not even considering student loan refi in 2021. So if, let's say, the worst case scenario kicks out, where they totally cancel, or even they extend from, the moratorium from May to December, the bad news is that we would probably see 200 to 300 million in revenues shaved off from, whatever it is. So that's the bad news. The good news is that it will obviously it will take their company to be more focused on, whatever that they have on loans, FS products, because that's their full suite, right? That's what they're offering. You come into SoFi, you're most likely going to use SoFi money, which they have data on you, and they'll, recommend you slowly to say, hey, we notice you got this amount, come and have a credit card with us. We got rewards to entice you with, we got this and that. So that's packed into their offerings and the sales and marketing and whatnot. And that's the good news, because the good news is it focuses on like being on other products and not being reliant on student loan refi, which is slowly, seeing a testament of what their revenues can be reflective of. So and if I were to work out how much of a contribution of personal loans would be in 2021, I think it would be 60%, because there was a halt on, student loan refi, right? So 60% of revenues, that's good. That's good news, right? Other than that, is annual adjusted Ebitda. We can see that actually having a positive figure. Now, later we'll be seeing the 10K, and we notice they're negative 500 mil in net income. Why? Because of DNA, right? DNA is really consisting of about 300 mil. Negative OPEX, is already contributing about 100 plus mil. So we're going to see that. But the good news is that EBITDA wise, the core operations of the business is positive, right? It's already positive. Already 6 consecutive quarters of positive EBITDA. Now, the bad news obviously is that the EBITDA is not like a staircase up. It's, sort of stagnant. But the good news obviously is that, it's positive, right? EBITDA positive. So the non-GAAP results versus guidance. Now, the adjusted net revenue, they have actual of 280 mil, okay, which is 2 mil lower than the Q4 2021 guidance. Now, again, I expected more. I expected them to beat, 290 easily, but they couldn't. So, the variance was 2 mil difference, whatever. And the EBITDA was actually at the high level, which is the good news. And again, I expected more because they had 10 mil in EBITDA the last quarter. But, it is what it is. Then we have, it's revenue was 1.1. Okay, so this is the full year. The actual was 1.01, which is 200,000 away from the high guidance, right? Total EBITDA for the year was 1 mil off the total 2021 guidance. Yeah. So again, it's actually insane that this company can actually reach this, what they promise. It says something about the management. And by the way, bear in mind, this is raised guidance. They achieved their raised guidance. So every time a company raises guidance, it's always good news, right? Because they can do what they can perform. And that's what I think will happen in 2022 if the student loan refis do not get canceled out or prolonged. Okay, that's what I personally think, because again, I'm being bullish, right? I'm bullish on this company because their marketing strategies, the way they do things is actually, more structured. It's good, right? They want to build a household brand name. They go with the full national bank charter, which they already have. They are going with SoFi Stadium, right, to attract people. They're going with young influencers, which is, YouTubers, right? They're going in the right channels, in my opinion. So when they do that, they sponsor that, they have a good mission, they literally want you to be better with your money. That, in my opinion, will, go long for the long run. Yep. So non-GAAP guidance in Q1, we expect 280 to 285 of adjusted net revenue. So again, if they achieve in the low guidance of this, it will still be all right? It'll still be good. But because it'll be up 30 to 32% year over year, and 0 to 5 of adjusted EBITDA. Now, is it okay that a company is still, within this EBITDA range, which is small, but we have to consider obviously their life cycle, they're young, all these things, and they're still, and being young companies, they'll need to push for, to rebrand themselves, right? The makeup, right? Sales, marketing. So I think it's all right, the guidance. It'll be obviously a blowout if they break the guidance, but then again, we need to see. But this is the guidance. So then adjusted net revenue for Q1 will be 280, high will be 285, EBITDA is 0 to 5. Okay. Now, they also gave illustrated a guidance if moratorium had expired by January 31st, that would contribute nearly 30 to 40 million in adjusted net revenues extra, right? So that's why I said, if let's say they do prolong the whole way, it's potentially a 40, no, yeah, it's potentially a 50 mil per quarter. You times by 4 is like 200, maximum 300 million shaved off from their revenues if they prolong the moratorium, right? So, we got bad news coming in if they do that. So we expect to deliver 1.57 B in adjusted net revenue and adjusted EBITDA of 180. So adjusted net revenue 2019, 2020. This is the actual 1B for 2021. And that's where I got the CAGR, right? So these are very impressive numbers, but the guidance in total, they expect 1.57B. Now, 1.57B is a 55% increase. And if we take the CAGR, and you guys can work it out yourselves, we can get a 63% CAGR throughout. So what's important is if we are long-term shareholders, we're definitely going to expect, we can use the CAGR, calculation to move forward. But ultimately, we have to break down to see whether or not 55% is achievable. And they already factored in interest rate hikes, okay? They already factored in the student loan moratorium to be, 200, I think contributing like 300 mil, not mistaken, in the whole year. So they already factored these in. If that really gets canceled, then this is something to think about. This is, again, another headwind, right? But also, another underlying story that we have to actually see is that, first of all, they are actually projecting 180 in adjusted EBITDA. Okay, 180. Now, the bad news is if you want to read between the lines, the adjusted EBITDA for the high levels of Q1 is 0 to 5. Okay, is 0 to 5. Now, 5 mil of Q1 means that they will have to perform 175 mil in EBITDA in 3 quarters. Do you see what I'm getting at? Because logically, let me take out my calculator. Logically, if you are projecting to, if you're telling to someone that investor relations or investors that your company will do 180 mil in EBITDA in 4 quarters, logically you'll divide that by 4. So if you divide by 4, it's 45 mil per quarter. But in Q1, they projected 5 mil. So that would mean 175 throughout, 3 quarters. And that means 58 mil adjusted EBITDA on average for 3 quarters. Okay. So the question is it far-fetched? Because it's a huge jump. It's a huge jump. So it's either the company is, reflecting better quarters for the remaining 2022 within the last 2 quarters, because that's where the student loan kicks in. But imagine if it gets canceled out, they would have to revise their guidance again, and then the stock price would fall. I mean, I'm actually putting out the worst case scenario. So I don't want to be the huge bull here when I'm saying, okay, this is what is good, right? This is what everything is all bull, go buy it now, their flywheel momentum, blah, blah, blah. But I don't want to just be that person. I want to be, okay, these are the tailwinds, these are the headwinds, what are the risks expected, blah, blah, blah. So that's what I want to say. Okay, that's what I want to say. Having 3 quarters of adjusted EBITDA to be 175 mil on average is, that what we worked out, which is, let's see again, sorry, 45 mil is a huge jump. So this is something to consider. But the good news is 180 mil is 11% of the revenues. And if we minus the DNA, and if they can lower the DNA and interest by 2022, we would probably expect profitability in 2 years' time. Yep, in 2 years' time. So non-cash items, stock-based compensation expense is actually increasing well, it's expected to increase simply because, still a growing company and whatnot, right? And I don't mind having more SBC because it means that the less cash is forked out, right? Less cash expenses, which will in turn improve their free cash flow, right? Similar to the Palantir story, right? We went through Palantir. So, Palantir is actually positive free cash flow because of operating cash flow. You add back the SBC expenses, which was 770 mil for Palantir. But anyway, the reason why I don't mind SBC increasing is because lesser cash, forked out, right? But the quantum amount is important. The quantum operating expenses is important. So that's what we have to highlight. So we got member growth. We already saw this. Products growth, lending products. This is, the company metrics. We got segment financials. So the good news is that there's a compounding effect taking in. Now, 2020 is obviously different because of COVID. That's where the whole loan originations actually dropped. But the good news is the home loan origination, well, the student loan origination is dropping, obviously. The good news is the personal loan origination is actually more than double, okay? Home loan is slow. This is not really their forte. And it's seen that they can actually capture more personal loan originations. So if you want to work out the net revenue average, in relation to the originations, it's actually 6 to 7%, right? How do I get that? 763 million in net revenues divided by the loan originations, which is 12 billion, puts you to around 6 to 7%. Yep. And that is the gauge that we can get. So on average, every origination they land is basically contributing 6% to 7% of revenues. Okay. So just the net revenue. Galileo technology platform, we got net revenue of 194 mil. And the OPEX is 130. So their gross profits, contribution profits is actually 64. Their FS net revenue is negative simply because the revenues are not as much, but their spending is much to acquire. So it's a negative 134 mil. What else we got? So net revenue, servicing rights, okay, adjusted revenue. So we can see very healthy, compounding in terms of net revenues. And what is this? Adjusted net revenue, non-GAAP, okay, adjusted Ebitda also having that positive effect, right? So it's slowly playing out. And if they have 180 for 2022, what is it to be expected of 2023, right? By my estimates, they will need 500 million in adjusted Ebitda in order to break even or get profitability by few mil. The reason why is the DNA already consists of 300 to 400 million. Okay, so that's how we have to work out, right? So I will jump this a little look into the DNA. Okay, so DNA, that's what I'm talking about, right? DNA here is already at 293. So, okay, no, sorry. So the stock-based expense is 239. The DNA is 100 mil. Yeah. So, and this is all non-GAAP. No, net loss is GAAP. This is non-GAAP. Okay. So what it means is the net income loss, which is GAAP, the actual figure that, the 10K is reported, this is negative of 483 mil. So the bad news is obviously it's expanding net losses. But that is because you have to deduct the DNA, right? You have to deduct the interest and taxes. You have to deduct, stock-based compensation, which was not reflected. So that puts a negative net income of 183. Now, you're probably thinking, shit, why? This is crazy. You're having growing revenues of 55%, but you're increasing your net loss at 100%. So that is the bad news, right? But the good news is if they have positive Ebitda, because bear in mind, 2021 was just adjusted Ebitda of 30 mil. If they have positive 180 mil in adjusted Ebitda, and their DNA hopefully decreases by a little bit, stock-based compensation will increase. That would put them closer to profitability, and the net income would actually decrease because of that, right? So let's see, fair value. Impairments, servicing rights, the bigger chunk. It's actually from fair value changes in warrant liabilities. That's the 107 mil. Yeah. So you deduct all of that. That's where you can actually get the adjusted EBITDA of 30 mil. But all in all, they would have to increase and compound the positive adjusted EBITDAs to be around 300 to 400 mil just to break profitability. And that might be 2023. Yeah, 2023, because the results of 180 is 2022. They would actually have to compound that. And if they can double or triple that adjusted EBITDA, there'll be more. So now, the good news and bad news is actually mixed up. But in my opinion, the good news is that in the transcript, they mentioned that the SoFi money, SoFi Bank, right, loans will be parked under SoFi Bank, and that is not reflected yet in Q4. Okay, that wouldn't even be reflected in Q1, not mistaken. They will only reflect that in Q2, and that's where we can really see the results of a bank kick in. What do I mean by that? So the ultimate, having a bank charter, which they recently got, the ultimate, the result fundamentally for that will be improving profits, okay, securing loans for a longer period, which will increase your profitability for 5 times, 4 times, right? So the result of that will only be kicked in by Q2, and that's where we can see expanding margins from there. Okay, so they already factored that in probably, right? That's why we got the EBITDA. But we can, in my opinion, we need to see that result to be actually projecting nicely for the, for 4 quarters ahead after Q2 when we see the results, right? So that's why we need to see, I think, 3 more months down the road, probably the stock price will be hovering from here because there's no catalyst. But obviously, if there's, if the market is getting better, there's no more war, then we can expect to see, rising stock prices. But my point is, in order for them to reflect profit, and bear in mind, bank charter profit margins are 20-25%. Okay. So that is not reflective and not kicked in yet, simply because of the results of SoFi Bank. And again, we still need to see more, things to come. Yeah. So what else we got? So this is their balance sheet. They got 494 in cash and cash equivalents, restricted cash 273, student loans, and all the assets that they have. Basically, the loans that they have, right, secured is, student loans 2.8B, personal loans 2B, home loans, which is a smaller amount, securitized student loans and all that. You got 6B in loans, right? So there are rights and securitization investments, basically the assets that they can have to the product, the products that they can have to actually roll, and the loan originations that they have amounts to, this much. So we got 6B. You add everything up, is 9B in total assets, but you minus off goodwill. This is probably the Galileo goodwill, and I think the Technisys goodwill, I'm assuming, or maybe that's not reflected yet. No, that's not reflected yet because that was just recent. Yeah, sorry. So we got 9B in total assets minus goodwill 1B. You got 8B in assets net, not net. I mean 8B in assets. Then you have, looking at the liability side, we have only 4.4B. Now this puts them at very good permanent equity of 4.37B, and this is, good news, right? In a way, that's why they're saying that in a way they have cash of 4.3B is because of this, right? If you, write off all your loans, you minus off the facilities that you have, that is why they are saying that they are 4.3B. But I won't take that in consideration, because if they were to acquire companies, they will just have to either take out from their cash or give shares, which they did in full shares for Technisys. But yeah, looking at this balance sheet is actually good news, because, facilities of 486, student loan warehouse facilities 1.1B, risk retention, senior notes, which they raised up 1.2. Now, this is a company that is getting slowly self-reliant, right? Yes, no doubt, they raised 1.2 billion in senior notes, which is convertible to ordinary shares. but it's slowly kicking out. Like it's slowly playing out. They don't need to rely heavily on their, the debt that they have. They are, slowly getting profitable, which they're not yet. But when they are, then, they don't have to rely on that anymore. And they're slowly playing it out. So every revenue they're actually getting, they're paying out debt. They're reinvesting into the business to get marketing, right? So that is the good news. So these are things to be expected on this company. Now, I'm going to quickly jump, and I think we don't have time for transcript. I did also say, mention a lot about the important points of the transcript, but I'm just going to just go through some, right? So we set another record with new product ads. We already talked about that. Galileo 100 mil. Third, we took a giant step forward in 2021 in achieving our goal, becoming a household brand name via SoFi Stadium affiliation. The success of our integrated multimedia campaigns and the virality of the influencers we partner with. Lending, we grew segment 30%. Okay, we looked into that. Financial services, we achieved 2x sequentially. Sorry, I missed that part about macro conditions, member growth. I want to talk about what we didn't go through, which is actually their marketing strategy, which they did highlight. Gaia, home loans, and we relaunched jumbo loans. Looking ahead, license opportunities, phenomenal growth. SoFi checking and savings, 1% APY. So it's the new product, 1% APY. Credit card, 91,000 products, 42% year over year. T-Row price, we're kind of Galileo to leverage and owned. And this is to be a growth multiplier for both SoFi and Galileo. Talk about number 2, the success of the FSPL productivity loop. 17% decline. Okay, so 17% decline in our customer acquisition costs. So this is what, that means. They more than tripled their products, right? And their decline in CAC. So when we see that slowly kicking out, and I remember Q3 was 8%, 17% is a lot. Yeah. They're slowly having that upsell movement. The FSPL was, after the top of the line funnel, they move into FSPL because, in a way, it's no brainer. Even if a member parks in like 10,000, it's still okay, because that's where they can slowly keep you more into the brand and, using more products. Key success, SoFi, brand awareness by nearly 70%. Okay, before turning on Chris. Okay, so Chris is the numbers. Yeah, so those are the key highlights. Oh yeah, that's where it is. Sorry. Brings me a factor. The 5 nationally televised regular season games, right, was seen by an average of more than 22 million households per game, resulting in a household reach of 110 million plus households in total. This visibility helped increase SoFi's unaided brand awareness by nearly 70% in 2021 to a new record in fourth quarter. And before, it was estimated 106 million people tuned into Rams and all that. So I missed out some because I have to wrap it up. I have another live going, but they did mention their strategy playing out from marketing of, influencer. Like if we watch Stephen Graham or those big YouTubers, we can actually see that actually reflected in their YouTube, and, they're sponsored. As long as they have a good cause for spreading financial awareness, it's going to be good, right? So this is it. Balance sheet 4.7 in equity value, exponential. Yeah, so this is it. Now jumping into the 10K, which I'm just going to jump into the numbers. Balance sheets. We looked at the balance sheet already. 9 point, permanent equity. Okay. Now let's look at the income statement. So 2021, we can see interest income, loans. And the loans. So the loans in interest income was significantly lower than 2019. Yeah. Total interest income is lower than 2019. Securitized interest expense, but the interest expense was way lower as well, because of the bank. No, not really. I'm not sure. But securitizations and warehouses actually significantly lower. Corporate borrowing significantly lower. Total interest expense 100 mil. So net interest income is 252. The non-interest income, however, is a lot higher than 2019. Loan origination and sales, minus securitizations, technology platform fees, which obviously contributed a lot because that's where Galileo kicked in revenues. So that put their net revenues at 984. So non-interest income was 7x more than what it was in 2019. Interest income was lower, and that put their total net revenue, which was double in 2019, to be 984. Now, the bad thing obviously is that, okay, with rising revenues, we have another cost to kick in, which is, the cost related to Galileo. They acquired the bank corp, so that the expenses there will also be, parked in here, make acquisitions, everything parked in here, and it's slowly getting revenues, right? So I'm not sure the revenues of the bank itself, the bank corp itself, but that's what they have to face. That's where younger companies will have to face, right? They recently make acquisition, it's reflected in their expenses, but as they grow revenues and they slowly cross by, that's where the total net revenues will actually increase, right? And by the way, this is all GAAP, yeah? So technology, 276. Now, if we work out the percentage of revenues, sales and marketing is actually 426 divided by 984. It's actually 43%. So this is very high. Yeah. Sales and marketing is actually 43%. Palantir is 40. It used to be 60, by the way, just for references. Cost of operations, 256. G&A is also around 498 divided by, it's nearly 50%. It is 50%, 51%, 50.6. So G&A is expanding, which is a lot. Now, being a neobank, you're supposed to have lesser G&A, right? But anyway, it is what it is. So G&A is 50+%. And obviously we have total non-interest expense, which is the OPEX, having more than the total net revenues. And that's where the net income is actually 483. So what do they have to do? They have to essentially grow everything in terms of revenues, obviously. But we can, knowing the qualitative, we can actually see what's happening in the technology side. So it's most likely, technology platform, it doubled, right? 190 from 90. What's the likelihood it can double again in 2022? It can. They're already securing more accounts, right? Technisys is there. So maybe possibly it could double, right? So if it doubles, it is adding another 190 mil into the board. 497 increase, this is probably like 30% increase. So the way we project it is we look at this, we can project, logically how how it will increase. And if, let's say, the revenues are projected more year over year, more than the OPEX, then we can get a decent run up, right? So the bad news, obviously, for the OPEX is that they are increasing, let's see, 1466 minus 894 divided by 894. They're actually increasing 64% in OPEX, right? Gap wise. So with a revenue increase of 63%, and wait, this is 63. Wait, let me work out. So 984 minus 565 divided by 565. Oh, okay. So the net revenues, gap wise, is increasing 74%. And the OPEX is increasing 63%. This trend must obviously continue where they can lower down. But at the moment, we can't see them being more lean, right? At the moment, we can't see, but it's hard to blame them because the acquisitions and I would say the breakout of inflection point is actually just in 2021, where they acquired, where they had setbacks, where they really acquired companies and they really had a bank charter. So if you would ask me whether good times will come in now, I would say yes, because bank charter is a huge game plan, a game-changing fundamental difference. And, we have all these things. So the conclusion for me in SoFi is that this year, knowing all the headwinds that is expected, right? We will probably see the stock prices going down, like hovering around this area. And I'm not surprised because, wars is taking a toll on everything, market sentiment wise. And they are not profitable yet. We can't really see the whole story playing out yet. So that's the negative, right? And we got that headwind of student loans. But on the good side, rising interest rates will mean better profits. Lower interest rates mean better adoption of, home loans and other loans. So, that could be a beneficiary in a way, especially higher profits for personal loans and whatnot. So that is the positive side. And bank charter hasn't been kicking in, right? The results of bank charter hasn't kicked in. What else? That is good. I'm trying to give some catalyst here. Their marketing strategy and top of the funnel is yet to be seen in terms of where, how they're going to attract more on SoFi Stadium and, the influencers. If that progression still compounds, then obviously it'll be good. And obviously the negative sort of, or the question mark is how are they going to get 175 mil in Ebitda where Q1 is only 5 mil, right? In adjusted Ebitda. So these are the things to consider. I'm still bullish on this company. I've, dollar cost average down, but it's already a significant portion of my portfolio. So I don't want to be too gung-ho in that case. Yeah. So operating cash flow is actually looking at the financing activities. Oh no, that's financing activities. Sorry. Operating cash flow is negative. They're negative 1.3 billion. That's because the changes is actually huge. Proceeds from sales and repayments. Okay, net loss. Yeah, so it's a huge operating cash flow negative. Their PPE is very small. It's just 52. But as if they can, expand this, then it'll be good. But, we can't really see that as of now. Financing activities. Okay, financing 684 mil. Not a lot. Yeah. Okay, so that's that, guys. Hopefully we provided some color on the earnings, their story, right? Their direction, what is to be expected this year. I'm ready. I'm mentally ready if their stock prices are just within 10, 11 or 13, which I'll still be making a loss because I already invested, long and I'm at the dollar cost averaging down. That's my point. But my point is that I'm investing in the long haul, right? Because it takes time for the fundamentals to be positive. It takes time for the net income to be positive. It takes time for, them to be really building that household brand, which is the future. And how fast they can actually take it will depend on, depend on the management and how they steer the company, right? So I hope you got some value out of this today. I'll see you guys next week. If you guys want to know, if you want me to talk about anything else in terms of a company like, Upstart or Palantir or any other company, let me know in the, in the chats in the group. And I'll see you guys next week. Bye-bye.